All right, welcome back to AI Explains ICT. Today, we are diving deep into some seriously powerful stuff from the core content, specifically Month 2, Episode 6. We're going to build from the ground up the exact blueprint for finding those high-reward trade setups. You ready? Let's jump right in.
So let's just get right to it. This is the question, right? It's the one that keeps traders up at night. What is the real secret to hitting those big winners? We all go through it, hunting for that magic indicator, that one secret pattern that's going to flip the switch. But what if we've been looking in all the wrong places? And boom, there it is. This is the big mindset shift you have to make. The secret? It's not some flashy signal that pops up on your chart. It's not about chasing price. ICT makes it crystal clear. The real key, the thing that separates the pros from the rest, is building a rock-solid, repeatable process. It's all about what happens before you ever think about clicking that mouse.
Okay, so let's talk about the biggest roadblock for most traders. It really boils down to this fundamental conflict, impulse versus process. It's that internal battle between just reacting to every little flicker on the screen and actually, following a deliberate plan. This right here, this is basically the map of a trader's evolution. On one side, you've got that impulsive, reactionary mindset. Let's be honest, that's where we all start. We're chasing signals, we're rushing into trades, it's pure emotion. But the goal, the entire point of this journey, is to move over to the other side, to become process-oriented, to be structured, patient, and analytical. That's where consistency lives. Okay, so how do we actually build a process that pulls emotion out of the equation? Well, ICT gives us a really powerful concept for this: binary decisions. Think of it like a flow chart for your trading. At every single step, the choice is simple. It's either yes or no, do this or do that. There's absolutely no room for guesswork, no maybe or I think so. This black and white structure is what starves emotion. It just can't survive an environment that clear.
All right, enough theory. Let's get our hands dirty and actually build this thing. We're going to walk through the exact step-by-step path to creating a trading model that forces those binary decisions and ultimately leads to real consistency.
Now, it's super important to understand that this is a hierarchy. You can't skip steps. It all starts with the foundation, patience. Without it, nothing else works. From there, you learn to define the right market environments to trade in. Then, you lock in your specific trade parameters. After that, you create your exact non-negotiable criteria for execution. See the pattern? Only then do you worry about understanding the why behind the trade, and finally, you log all that experience to get better and better over time.
This is the perfect way to visualize it. It's a ladder. You gotta climb it one rung at a time. So many traders try to jump straight to the execution rung without ever mastering patience or learning how to define the environment. And what happens when you skip rungs on a ladder? You fall. Simple as that.
Okay, now we're getting to the real engine of this whole process. This is the core framework from ICT. It's a top-down approach that gives you a complete 360-degree view of the market. Think of it like looking at a map from 3 different altitudes, from space, from a plane, and from the ground. It's all about making sure everything is pointing in the same direction before you risk a single dollar.
So here they are, the 3 pillars: the big picture perspective, the intermediate perspective, and the short-term perspective. And listen up, because this is probably the most important rule in this whole video. A genuine, high-reward, A-plus setup only, and I mean only, exists when all 3 of these perspectives are in total agreement. If just one of them is off, you walk away. The trade is invalid. It's that simple.
All right, let's start from the top, the 30,000-foot view. This is the big picture. This is our long-term strategic analysis. The whole point of this step is to figure out which way the major institutional tide is flowing. Are we in a bull market or a bear market? We have to know which way to swim before we even think about getting in the water.
So how do we determine that big picture bias? ICT gives us 4 major drivers to look at. First up, you've got macro market conditions. Are we in a growth phase or is recession looming?
Next, you've got to look at interest rates. Are they going up or down? This is huge for currencies. Third, we have intermarket analysis. What are related markets like bonds, stocks, or commodities telling us? And finally, you check your seasonals. Are there predictable patterns for this asset at this time of year? These are the 4 pillars of the long-term view.
Now, here's a really important rule that makes this whole thing manageable. You don't need to wait for all 4 of these things to be perfectly aligned. That's super rare. ICT calls it the rule of 2. You just need a clear agreement between at least 2 of them. So, for example, if the macro environment is screaming inflation and the interest rate trend is pointing higher, bam, you've got your bias. You don't need to wait for the other 2.
Okay, so we've established the big long-term tide. Now it's time to zoom in. The next 2 layers, the intermediate and the short-term views, are all about taking that broad directional bias and refining it, sharpening it, until it becomes a specific, actionable trade idea.
So for our intermediate view, we're looking at 3 things. First, good old top-down analysis on your monthly, weekly, and daily charts. Second is the Commitment of Traders Report, or COT data. This literally tells you what the big banks and hedge funds are doing. And third is market sentiment. Is the market extremely greedy or fearful? And guess what? The rule of 2 is back. We just need 2 out of these 3 to line up with our big picture bias to move forward.
And now we get to the final layer, the short-term view. This is where the rubber meets the road, our execution time frame. Here, we're looking at correlation analysis, making sure related markets are confirming our move. We're applying time and price theory. Are we at the right time of day and at a key level? And of course, we're looking at IPDA, the Interbank Price Delivery Algorithm. Now, pay attention because the rule changes here. For this final confirmation, it's not the rule of 2. You need all 3 of these components to be perfectly in sync. This is your final green light.
All right, we've covered the mindset. We've gone through all 3 perspectives of the framework. Now let's put it all together. Let's reveal the exact formula for finding those A-plus high-reward setups we've been talking about. So what does it all add up to? What's the number? It's 7. That's it. To build a truly high-probability, high-reward trade setup, you need a grand total of 7 specific factors, all aligned across the 3 perspectives, all singing the same song.
And here it is, the blueprint in black and white. It's a simple formula. 2 plus 2 plus 3. That means you need a minimum of 2 factors from your big picture analysis. You need a minimum of 2 factors from your intermediate analysis. And you need all 3 factors from your short-term analysis. When you have those 7 pieces locked into place, that's when you have real clarity. That's when you have conviction. That's when you know for sure that you are trading based on a process, not just a random impulse.
And I want to leave you with this quote from ICT because it just perfectly sums up the entire professional mindset. He says, you want your trade to be boring. You want it to be monotonous. That's when you know you're not going to be forced by emotion. Think about that. The goal isn't the adrenaline rush. The goal is consistent, precise execution. And when a trade feels boring, almost like you're just checking boxes, that's a good thing. It means your process did the heavy lifting and your emotions weren't even invited to the party.
So there you have it. That's the framework, from top to bottom. I really hope this video helped connect the dots for you. If it did, do me a favor and hit that like button. And make sure you're subscribed so you don't miss the next one. And seriously, if you have any questions at all, drop them in the comments below. We have real humans who read and respond to every single one. Until next time, stay safe and safe trading.